In September 2008, the United States government did something it had never done before. It handed over $85 billion to an insurance company. Not a bank, not a car manufacturer, an insurance company. And here is the part nobody talks about. They did it over a weekend. No vote, no debate, no public announcement until after the deal was done. The Treasury Secretary, a man named Hank Paulson, got on his knees, literally, physically got on his knees in the Speaker of the House's office and begged her not to blow up the deal. That actually happened. And the reason it happened, the reason the most powerful financial system in human history was brought to its knees in about 18 months, comes down to one idea. One deceptively simple idea that everyone from Wall Street traders to your neighbor refinancing his third house decided to believe at the exact same time. That house prices only go up. Let's go back, way back, to a time when getting a mortgage was boring. It's 1990. You want to buy a house. You walk into a bank. A man in a bad tie looks at your income, your savings, your credit history. He runs some numbers. He says yes or no. If he says yes, the bank lends you the money. And for the next 30 years, you send that same bank a check every month. Here is the critical detail. The bank keeps your loan. It sits on their books. So if you stop paying, that is the bank's problem, which means the bank has every reason in the world to make sure you can actually afford the house. That system, slow and annoying as it was, had a built-in immune response. Then someone had an idea. What if the bank didn't have to keep the loan? What if the second you signed the mortgage, the bank could sell it to someone else? Package it up with thousands of other mortgages, turn it into a financial product, and sell that product to pension funds, hedge funds, and German municipal governments. What if the bank could get all its money back immediately, today, and then turn around and make another loan tomorrow? Suddenly, the bank's job wasn't to make sure you could pay back the loan. The bank's job was just to make the loan. This is where it gets interesting, and a little insane. These mortgage-backed securities, MBS for short. The idea was not entirely new, but in the early 2000s, they became an obsession. Here is why Wall Street loved them. After the dot-com crash in 2000, investors were terrified of stocks. They wanted something safe, something with a real asset behind it. A house is real. You can touch it. It doesn't disappear like a tech startup with no revenue. So Wall Street said, we have exactly what you need. And they went to the ratings agencies, the companies whose entire job is to tell you how risky something is, and they said, rate these bundles. The ratings agencies looked at the math. Thousands of mortgages from all over the country. Surely they wouldn't all fail at once. Different states, different borrowers, different incomes. The risk was spread, diversified. AAA, the safest possible rating, same as U.S. government bonds. So now you have a product that pays higher returns than government bonds and carries the same theoretical risk. Every major institution on earth wants it. Pension funds for teachers in Ohio, investment banks in Iceland, the Norwegian Sovereign Wealth Fund. The world is buying American mortgages, which means Wall Street needs more mortgages to sell, which means the mortgage originators need to make more loans, which means the standards for who can get a loan start to move, quietly, then dramatically. In 2003, you needed a job and a down payment to get a mortgage. By 2006, there were loan products called ninjas. No income, no job, no assets. Not a joke, an actual product with an actual name. But wait, the ratings agencies were supposed to catch this, right? Here's the uncomfortable math. The ratings agencies were paid by the banks whose products they were rating. Read that again. The people being graded were paying the people doing the grading. And if one ratings agency gave a bundle a bad rating, the bank would simply walk across the street to the other ratings agency.
So every agency had a financial incentive to say yes, to call things safe that were not safe. On top of that, there was another layer, something called a CDO, a collateralized debt obligation, which sounds technical and intimidating, but is essentially this. Take the riskiest parts of the mortgage bundles that nobody wanted to buy, put them together in a new bundle, get them rated, and sell those. They called the riskiest layers toxic waste internally. Then they packaged the toxic waste. And then, and this is the part where the story becomes almost satirical, some banks started creating synthetic CDOs, products that didn't contain actual mortgages at all, just bets on whether mortgages would fail. Pure speculation, dressed up in financial language so dense that even the people selling it sometimes couldn't fully explain it. By 2007, the global financial system was not just exposed to the American housing market, it was leveraged against it. Meaning, institutions had borrowed money to buy these products, multiplying their gains and, invisibly, multiplying their potential losses. The whole thing was a machine that worked perfectly up until it didn't. In 2006, house prices stopped going up. That's it. That's the trigger. Not fraud, not a war, not a natural disaster. Prices just leveled off. In some markets, they dipped, and the entire machine seized. People with adjustable rate mortgages, loans where the interest rate was low at first and then climbed, started missing payments, then defaulting, then walking away from houses worth less than what they owed. The bundles started losing value, then the CDOs, then the synthetic CDOs. And because every major bank in the world held some version of these products, nobody knew how exposed anyone else was. You could not look at a balance sheet and trust it, because somewhere in that balance sheet was a bundle of bundles of bundles of loans made to people with no income, no job, and no assets. Banks stopped lending to each other overnight. In normal times, banks lend each other money constantly, billions of dollars, just to manage their daily operations. When that stops, the whole plumbing of the global economy locks up. Bear Stearns collapsed in March 2008. J.P. Morgan bought it for $2 a share. $2, a company that had traded at $170 a share less than a year earlier. Lehman Brothers filed for bankruptcy in September 2008, the largest bankruptcy in American history. Still is. And then back to that weekend, back to that insurance company. AIG had been selling something called credit default swaps, essentially insurance policies on those mortgage bundles. If the bundles failed, AIG had to pay out. AIG had sold somewhere around $500 billion worth of these policies. AIG did not have $500 billion. The government let Lehman fail. It decided it could not let AIG fail, because AIG's collapse would trigger payouts across every major bank simultaneously, a cascading, simultaneous explosion. So they handed over $85 billion on a weekend, on their knees. What happened next is a story for another video. The short version, 8 million Americans lost their jobs, nearly 4 million families lost their homes, the stock market lost half its value, the global economy contracted for the first time since World War II, and the people most responsible for building the machine, the executives who made hundreds of millions of bonuses during the boom years, overwhelmingly kept their money. One banker went to prison in connection with the crisis. One. There's a number that tends to stop people when they hear it. The Federal Reserve, the U.S. central bank, issued emergency loans during the crisis, not the $700 billion bailout you heard about on the news, the other one, the secret one. Over the course of the crisis, the Fed lent out approximately $7.7 trillion to financial institutions. That number was not disclosed publicly until Bloomberg News sued the Fed under the Freedom of Information Act 2 years later. The financial system was saved. The public was told about it afterward. Here is what worth sitting with. Nothing that happened in 2008 was inevitable. Every step, the deregulation, the rating inflation, the leverage, the opacity, was a choice made by identifiable people at identifiable moments, often for very understandable short-term reasons. Nobody woke up one morning and decided to crash the global economy. They just each decided individually that the music was still playing and that someone else would be standing when the chairs ran out. The system was rebuilt after 2008. New regulations, new oversight, new safeguards. And if you ask most economists whether a crisis like that could happen again, in some form, in some corner of the financial system that nobody's watching closely enough yet, they will pause. And then they will give you an answer that is technically reassuring and somehow leaves you more unsettled than before you asked. Subscribe for the next video.